A quick one. Let's go back to 2020-2021. Yes, 2020 started like it had no goodies in store for cryptocurrencies. But fast forward to the early months of 2021, investors started to see big gains, and many new entrants swarm into crypto waters. Enthralled by those pretty gains, Bitcoin hit new all-time highs that launched every investor in awe. However, those who sold their coins before the bull run started had their fingers bitten in regret. It seems like the same scenario is about to play out right now. This is the cryptocurrency market, a dynamic and ever-evolving landscape characterized by its extreme volatility and substantial price fluctuations. We will never forget that salient truth. Over the years, the market has witnessed several bull runs, attracting both institutional and retail investors. As noted, the most significant bull run occurred in 2020 and extended into the early months of 2021. Cryptocurrencies, notably Bitcoin and Ethereum, experienced a massive surge in price, reaching unprecedented all-time highs. Bitcoin, the lead cryptocurrency, nearly touched $42,000, while Ethereum surpassed $2,000 during this period. Just like what we are experiencing right now, several factors contributed to the 2021 bull run, including heightened institutional interest, macroeconomic uncertainties, and the growing recognition of cryptocurrencies as an asset class. A major plus was the influx of retail investors and the increasing acceptance of cryptocurrencies in traditional finance, which all played a pivotal role in driving up the prices. With these factors, there are some similarities and expectations that we can trace in the previous and upcoming bull runs. In both the last and anticipated bull run, institutional involvement has been a significant driving force. Institutional investors have increasingly shown interest in cryptocurrencies as an investment asset, and this trend is likely to continue in the forthcoming bull run. Major financial institutions and corporations are exploring ways to integrate cryptocurrencies into their portfolios. Also, fear of missing out, aka FOMO, was a prevalent factor in the last bull run, driving prices to staggering heights. And it's not surprising that there is a repetition of this occurrence. Who wants to miss out on the crypto party? The fear of missing out is expected to reoccur in the upcoming bull run, thus amplifying price movements. However, one significant difference between the last bull run and the upcoming one could be the regulatory environment. Regulatory clarity has progressed since 2020, with many countries outlining their stances and regulations regarding cryptocurrencies. These regulators might attract more institutional investors, potentially influencing the trajectory of the bull run. Well, it's important to note that the cryptocurrency market has matured since the last bull run. More robust projects, improved infrastructure, and a more educated investor base could impact how the upcoming bull run unfolds. Investors might be more discerning, focusing on projects with genuine utility and potential. And we should not be surprised if some have not learned from their past mistakes concerning investments. Now that the cryptocurrency market is poised for yet another potential bull run, institutional involvement and market speculation remain consistent. Factors like regulatory clarity, market maturity, technological advancements, and a notable price milestone of $69,000 reached by Bitcoin in November 2021 could influence the dynamics of the upcoming bull run. Investors are advised to approach this volatile market with careful consideration, thorough research, and a long-term perspective to navigate the anticipated surge successfully. Recently, there have been bullish runs for Bitcoin and other crypto assets that cause for celebration, but investors should be careful not to repeat the mistakes from past bull markets. With Bitcoin continuing its upward swing towards the end of 2023, recently hitting $44,000, the mood and sentiment have turned more optimistic. So far, we have experienced a roll of several unpleasant events this year. In a year that saw the trial and conviction of FTX CEO Sam Bankman-Fried on multiple accounts, the admission of guilty by Changpeng Zhao and Binance on criminal charges, and multiple lawsuits filed by the SEC against the space, the recovery in Bitcoin prices can be seen as good news. When combined with the growing speculation that a Bitcoin spot ETF is due to be approved in the short term, market sentiment had become positive as 2023 came to a close. Even as these good headlines and coverage flow through the media landscapes, significant challenges remain for the space to surmount. The continued antagonistic position that the SEC seems to take on every crypto is an issue that needs to be sorted. We have dealt with that problem all throughout last year. We are ready to let go of the memories of these sad occurrences. Price appreciation and increased adoption of Bitcoin and the wider crypto asset space are something that should be celebrated. It's like a form of solace to all the rigorous moments, but as usual, investors should be wary of repeating past mistakes. Looking back at the crypto bull run history, you would find out that all of them happened after Bitcoin halved. For example, the previous bull runs were in 2013, 2017, and 2021. Surprisingly, the Bitcoin halving schedule had milestones in 2012, 2016, and 2020, thereby indicating a pattern that connects Bitcoin halvings to crypto bull runs. If you consider the pattern, the next crypto bull run might materialize in 2025, after the Bitcoin halving in 2024. However, the crypto industry has evolved beyond the Bitcoin-centric focus. There are many trends to consider. The Bitcoin halving event has been a major driving factor for bull runs, but attributing to the halving process as the only factor responsible for Bitcoin's halving is far from reasonable. Now, let's watch out for next year. Bitcoin goes into the first quarter of 2024 with two specific events set to determine price action in Q1. These events are the launch of the spot Bitcoin exchange traded fund and the run-up into the latest Bitcoin halving event. While there is historical evidence about how Bitcoin trades into and after a halving event, the potential introduction of a slew of spot Bitcoin ETFs and how that will affect its price action is still unknown, but at least the outlook is still bright. The US Securities and Exchange Commission has 12 spot Bitcoin ETF applications sitting on their desk. These include applications from heavyweight institutional names like BlackRock, Fidelity, and Invesco. While the SEC is still looking at all 12 applications, the current market reflection is that a spot Bitcoin ETF may be approved sometime in January 2024. Plus, there is a strong conviction that if one application is approved, the SEC may approve all 12 applications at the same time, so that no ETF provider has a first-mover advantage. Looking at the big picture, a spot Bitcoin ETF would bring Bitcoin to a wide range of new and current investors, increasing mainstream adoption of an asset class that has long been unregulated. Increasing adoption would increase liquidity and reduce volatility, while a regulated product issued through some of the world's largest fund managers would ease concerns over bad actors acting with fraudulent intentions. While it is difficult to estimate the potential demand that these ETFs may have, new demand for underlying Bitcoin from these ETFs may drive its price by market capitalization much higher. Regardless of the expected massive returns, many claim to loathe Bitcoin and, in general, cryptocurrencies. Several critics have sustained an antagonistic perspective on the crypto market. However, it seems like some are starting to change their stances. JP Morgan CEO Jamie Dimon is facing criticism from the crypto community on X after being named an authorized participant by BlackRock, which dropped its update from the S1 filing on December 29th. Commenting on the BlackRock amendment, Bloomberg ETF analyst Eric Balchunas said, BlackRock just dropped its updated S1, and it does name the APs, Jane Street and JP Morgan, which is kinda ironic. An authorized participant is an organization with the right to create and redeem shares of exchange-traded funds. This is shocking because Dimon has not endorsed Bitcoin publicly. In a December 6, 2023 hearing of the United States Senate Banking Committee on Oversight of Wall Street Firms, Dimon told several US lawmakers that if he had the authority in government, he would try and shut down crypto, claiming Bitcoin and cryptocurrencies' only true use case is to facilitate crime. With the latest development, crypto pundits have quickly pointed out the hypocrisy of JP Morgan as an authorized participant in BlackRock's spot Bitcoin ETF. Perhaps money laundering, tax evasion, criminal participation, and drug trafficking is their business as well, a crypto enthusiast, Silver Zimmerman, said on X. If BlackRock wants to do all that, then fine, but how can JP Morgan do all that after telling Congress and Elizabeth Warren that this is what it's used for? Another user, Sonny Poe, asked on X. Pro-XRP lawyer John Deaton also expressed skepticism about Senator Elizabeth Warren's stance on Bitcoin and pointed out that Dimon is willing to be involved with Bitcoin despite negative association with criminals. Deaton questioned whether this was an attempt to mislead the public or engage in gaslighting. John Deaton wrote, "How about that, at E. Warren? Jamie Dimon at JP Morgan is involved with #Bitcoin, despite its only use case serving terrorists, drug cartels, and other criminals. Or maybe you and Jamie Dimon are simply gaslighting the American public." Well, many shocking developments will unfold as we progress into the bull run. However, in all you do, don't sell your coin. You're just about to enjoy the good of crypto. But that's going to do it for today's video. Make sure you click on subscribe and notification buttons, and we'll see you in the next video.